Good morning. We will pay attention to the two inventory systems and we will compare the perpetual inventory system with the periodic inventory system. Only entries in connection with inventory and cost of sales are affected by these two methods. All the other entries are done in exactly the same way. When inventory is purchased, the inventory account will be debited in the perpetual system. When inventory is purchased, the purchaser's account will be credited in the periodic inventory system because you are not allowed to use your inventory account. Inventory is an asset, purchases is an expense. When inventory is sold, the cost of sales account is debited and the inventory account is credited with the cost price of the goods. When goods are sold in the periodic inventory system, no entry will be recorded for the cost of sales. When inventory are returned by clients, the inventory account will be debited because the inventory increases with the cost price of the goods that was returned, and the cost of sales account will be credited to reduce the expense for cost of sales. When goods are sold or returned by clients, no entry will be recorded in the cost of sales or inventory account when the periodic system is used. Cost of sales determined after each transaction. The inventory account is used every time inventory is purchased, sold or returned. So you will keep a continuous record of the inventory on hand in the perpetual system because every transaction that will increase or decrease inventory will be recorded in the inventory account. In the periodic system, the cost of sales is calculated at the end of the financial year. You don't have a cost of sales account and you don't use the inventory account during the financial year. When goods purchased are returned to suppliers, the inventory account is credited to reduce the inventory on hand. When goods purchased are returned to suppliers, the creditor's allowances account will be credited. So when we buy goods, we increase the purchaser's account, and when we return goods to creditors, we will record it in the creditor's allowances account on the credit side to reduce the expense. When goods are donated or taken for own use by the owner, the inventory account is credited to reduce the amount of inventory. When goods are donated or taken for personal use by the owner, the purchaser's account will be credited because we want to decrease the expense for purchases because this goods that was originally purchased with the purpose of selling at a profit is now used for something else and can't be part of the expense for purchases. An entry is recorded at the end of the financial year for the difference between the theoretical inventory and the physical inventory count. The theoretical inventory is the balance in your inventory account. The physical inventory count is the total amount of inventory according to stock taking. The inventory account will be decreased if there's a difference between the theoretic and physical inventory count, and we will create an expense inventory deficit. No entry is recorded for inventory deficit because it will automatically be absorbed in the cost of sales. Closing stock count will lower than the increase of cost of sales. So because in the periodic system, we don't use our inventory account, at the end of the year when the stock taking is done, the amount of inventory will be lower than it should be if there was any losses or burglaries, thefts, fire that destroyed some of the inventory. And because this closing stock count will be lower, it will automatically increase the cost of sales.